Hello everybody, my name is Lush Eisen and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record a video per week, so make sure you ring the notification bell to get notified each time one comes out. I will continue a new thing I'm trying for 2025. If you comment on this or the other videos that come out in March 2025, I will put you in a draw for a 1-hour one-on-one mentoring video call with me, a $50 value. We can look at your portfolio, talk about financial independence, personal finance, retirement, whatever you'd like. So comment below. Up to 5 entries are allowed, 1 per March video. I had a question about REITs and why they are so inexpensive. So let's take a look. A real estate investment trust, or REIT, is a company that owns, operates, or finances income-producing real estate. REITs allow individual investors to earn a share of the income produced through commercial real estate ownership without actually having to buy, manage, or finance any properties themselves. So what do? REITs invest in a wide range of property sectors, including apartment buildings, office buildings, retail centers, hotels, medical facilities, data centers, cell towers, and warehouses. Most REITs operate by leasing space and collecting rent on the properties they own, which generates income that is then paid out to shareholders in the form of dividends. Structure. REITs are structured similarly to mutual funds, where they pool capital from many investors to purchase and manage real estate properties. To qualify as a REIT, a company must meet certain requirements, including investing at least 75% of total assets in real estate or cash, earning at least 75% of gross income from rents, interest on mortgages or real estate sales, and paying a minimum of 90% of taxable income in the form of shareholder dividends each year. Some benefits. They're income generating. REITs provide a steady income stream through dividends, as they are required to distribute at least 90% of their taxable income to shareholders. They are liquid. Most REITs are publicly traded on major stock exchanges, making them highly liquid compared to traditional real estate investments. They provide diversification. REITs offer diversification by investing in various types of properties across different locations. And accessibility. REITs make real estate investing accessible to smaller investors who may not have the capital to purchase properties directly. Well, let's look at some pros and cons. First, the pros. High dividend yields. REITs often offer attractive dividend yields due to their income distribution requirements. Portfolio diversification. Investing in REITs can help diversify an investment portfolio and reduce overall risk. And finally, professional management. REITs are managed by professionals who handle property acquisition, management, and leasing, and they definitely charge you for it. Then some cons. They are sensitive to interest rates. REITs can be sensitive to interest rate changes, which can impact their performance. Being real estate, most REITs will borrow in order to purchase the real estate, and therefore they are heavily mortgaged. And if interest rates go up, this could definitely translate to their bottom line. The tax treatment. Dividends from REITs are typically taxed as ordinary income, which may result in higher tax liabilities for investors. Please check each individual REIT for how their distributions are taxed. And lastly, there's market volatility. Like other publicly traded securities, REITs can be subject to market volatility. But if you own real estate directly, that is generally not as volatile. And some macro events will not affect your real estate as they would a REIT, because it is publicly traded. Just out of interest, let's take a look at some differences between US and Canadian REITs. First, the tax treatment. US REITs, they are exempt from paying federal income tax as long as they distribute at least 90% of their taxable income to shareholders, so they make sure that they do. Canadian REITs, similarly, they are not subject to corporate income tax, provided that they meet certain conditions, such as distributing, again, a minimum of 90% of their taxable income to unit holders. That way, the REITs will kick off good cash flow, but there may not be much share price appreciation. Next is the regulatory environment. Just differences in regulators. The US REITs are regulated by the Securities and Exchange Commission, SEC, while Canadian REITs are regulated by provincial securities commissions. The portfolio structure. US REITs tend to have a more diversified portfolio with larger number of properties across different regions and sectors, just by them being bigger because the US is bigger. Canadian REITs often have a more concentrated portfolio with smaller number of properties. Sector focus. The US REITs typically have a higher proportion of their assets in the commercial and office sectors, while Canadian REITs tend to have a higher proportion of their assets in residential sector. And lastly, tax implications for Canadian investors. For US REITs, Canadian investors may face withholding tax on distributions, and they can claim a foreign tax credit on their Canadian income tax if they pay tax in the United States. For Canadian REITs, investors can buy the REIT through registered savings accounts like tax-free savings accounts and registered retirement savings accounts to save on taxes. Finally, I agree with the original question about REITs being priced fairly low. This is due to several factors. Number one is the interest rate increases that we've had some years back, and they've only partially come off. The higher interest rates can negatively impact REITs because they increase borrowing costs for real estate companies. This can lead to reduced profitability and lower dividends for investors. Additionally, higher interest rates make other income-generating investments like bonds more attractive compared to REITs. Secondly is the economic uncertainty. Economic uncertainty such as concerns about inflation, a recession, or geopolitical events or tariffs can lead to reduced investor confidence in the real estate market. This can result in lower demand for REITs and decline in their prices. Thirdly, we have a tightening of lending conditions. Tightening lending conditions can make it more difficult for real estate companies to secure financing for new projects or refinancing existing debt. This can limit growth opportunities and negatively impact the performance of the REITs. Number 4 is declining property values. So declining property values can reduce the overall value of a REIT's portfolio, leading to lower net asset values and a reduced investment confidence. With the real estate market being a little dodgy in the last few years, some properties have declined in value. While residential REITs or industrial property REITs have had an easier time of it, office properties or retail properties might be down in value. And then we have market volatility, which can lead to fluctuation in REIT prices as investors react to changing market conditions and sentiment. So that concludes my look at REITs and why they have been down for at least the last year. Let me know if you use REITs, which ones, and what you like in your portfolio. And of course, comment to enter the draw for the one-on-one mentoring for March. If you have any requests on what you'd like me to cover in future videos, please put that in the comment section. If you'd like to get in touch, please reach out on any of these social media channels, and may you have a profitable day.